welcome to another Between the Two Fiduciaries here. This week we're going to be talking about the S&P 500. So this first slide that we have here, Jimmy, it shows the sector performance over the course of this year. And the thing that stands out pretty dramatically is the energy sector has performed quite well. In fact, it's the only one that's performed well. Even if you want to call it one of its brothers, the utilities, has underperformed. But a lot of things below zero here and only one above.
Yeah, I think there's 11 sectors that make up the S&P 500. You have one clear winner in 22. I think we've all felt the cost of higher gas prices, but the energy companies have certainly done well in 22, and far better than the other 10 constituents in the S&P 500.
And the other notable thing here is that technology, communication services, they're kind of lagging behind this year, whereas they've been sort of at the vanguard in the last few years. They've been at the top of the heap.
Yeah, for the last decade plus, those have been the primary drivers of most of the performance of the S&P 500.
So the next one we have here is a slide about price to earnings, and it shows that price to earnings trend over since 1993 up until current. So actually that's 1988, my bad. And so what you're going to see here is obviously a few spikes. You see that big spike in the center of this slide here. That's from the 08 recession. You had PE ratios above 100, which was wild, and then their average is 24.5. We're just below that right now. What's your interpretation on this, Jim?
Well, again, at some point in time, price matters, and with stocks, it's certainly something that we'd like to be buying on sale for. If you were a longer-term investor, buying when it is below its long-term average has historically been a great opportunity for investors.
All right, our next slide here is coming up. This is a fantastic table, and it's so worthwhile diving into the details here a little bit. Since 1950, the S&P 500 has had 9 periods of time where it's dipped below 25%. So those are big bear markets, and they've lasted for different periods of time. Sometimes sort of a blip on the radar screen, sometimes a little bit longer. And what we're seeing in this table, though, folks, is how much the decline was. And then in the green sections of the table, you get to see how the response was in the S&P 500 after it hit its trough, its bottom. It rebounds off its bottom, and sometimes pretty dramatically. So as you can see in year one from the trough, the average there is 47.5. Moving forward 3 years, the average is 70% plus. 5 years, 123%. 10 years on, it's 244. So we've got a really, really interesting story to tell here when it comes to how the market declines and then it rebounds. So yes, this chart is really, really impactful in so many different ways, and I'm kind of wondering what your interpretation is here, Jim.
Yeah, I think the thing that sticks out to me is this is understanding why you get rewarded for long-term holdings of stocks. You have to be willing or able to live through some of these unfortunate declines, but those declines are what create the opportunities for long-term investors to earn the returns that they are looking for with the equity risk premium.
The emotion is so strong to remove yourself from the pain and suffering associated with a 25% plus downturn in the market, but there is light at the end of the tunnel, and that's
Absolutely.
what this is showing, right? I mean, this is showing that, if you stick in for the long term, if you take that long-term vision, there are rewards.
Absolutely.
Well, that's all we have this week for Between Two Fiduciaries. Thanks once again for signing in.